All right, so we're going to pick up here, Chapter 6, Cost Behavior. So again, this is a continuation of our Chapter 2/Chapter 6 week of the semester. So we'll pick up here, Chapter 6. And again, here we're going to talk about cost behavior and really build upon that fixed, mixed, variable cost that we got to at the end of Chapter 2, maybe just a few seconds ago or a day or so ago, depending on the timing of when you're going through these presentations and how you broke up the two chapters. So again, we're going to add equations to express and predict costs. And again, why managerial accounting, why we focus so much on how costs behave and understanding how cost behaves and breaking those into the categories is really so we can predict our costs. And why is it important to predict costs? It's because businesses, that's how they develop budgets, forecast, plan for the future, and we want to know how much cost we'll have to get to a certain revenue level, and we need to know how much the cost will be. That way we know how much cash, how much capital we need to have available to really continue to run our business. So it's vitally important. And when we go through and we identify, is it a true variable cost or a fixed cost or a mixed cost, that way we can just ramp up or ramp down our activity and our cost estimations based off of what we think our revenue levels will be and our activity levels will be. So when we talk about our variable costs, and we have our good definition here, and you can remember back from our diagram, which was in the last presentation, our variable costs are costs that are incurred for every unit of volume. So every item we make, we're going to have this additional variable cost. Our total variable costs, those are going to go up or down depending on our changes in volume. More volume, more variable cost, less volume, less variable costs. Again, if it's a true variable cost, when we have our graphing it out or visualizing our cost, our graphs will always be at the origin, because if it's a true variable cost, if we have no activity, no volume, our cost will be zero. And the slope there, basically how steep the rise will be, is basically the variable cost per unit activity. So we can see here at $3 per guest, we have kind of almost a straight line there, kind of perpendicular to the x-axis. We can go on up slightly for every additional guest. We have an additional cost of $3. If we have 0 guests, in this case it's thousands of guests, so if we have 0 guests, this variable cost is 0. As we go up, it's going to go up and up and up at a steady, constant $3 per guest. So our activity level, as we go up and down from left to right, when we start at 0, it starts at very low, and then as we go up and up and up, it's going to go higher and higher. On the flip side, if we start at the right-hand side, so the 5,000 guests, and move our way back down, our total variable cost is going to go down. So that was that diagram I was telling you back in the Chapter 2 presentation, the other YouTube presentation you might have watched. As we go up, it costs more. As it goes down, less volume, it goes down. But it's going to be at a constant $3 per guest for Part A. Part B, $10 per guest. We can see it's a much steeper climb. Our cost rises faster and faster and faster as we have additional guests coming in. But we'll see, because it's a true variable cost, if we have 0 guests, we have zero cost for that breakfast and refreshment. So our cost equation for our variable cost, so basically that's just a mathematical equation for the straight line. So our equation is our total variable cost, or Y, equals our V times X. And our V is our variable cost per unit, our X is our volume of activity. And we're going to basically go together and we'll see, here's our variable cost, we're going to next look at our fixed cost, and then we're basically going to put those two equations together to come up with our mixed cost. So we can see here, again, Y is our total, V is our individual cost, and then X is the number of activity. So if we know our V, our variable cost per unit, the what we're going to look at and how it's going to change, go up or down, is the volume of activity. And you can see based on, it's basically V times X. So if X, our volume, is 0, Y is also going to be 0, because anything times 0 is 0. So we can see if it's a true variable cost, we can have anywhere from 0 cost to basically infinity, depending on the amount of activity. So we have some key characteristics. I think we've covered these pretty good. This particular slide is in the standalone PowerPoint slide that's on my courses. So if you want this one to be up kind of as a refresher, you can go back there and look there. But I'm just going to kind of skip over it because I think we've covered most of it in the presentation so far. Next, we have our fixed costs. And again, those are costs that do not change in total despite changes in volumes. And here we have some examples. And again, the first one there, if we think about our property taxes and insurance, and if anyone has a house, or their parents have a house, or a friend of theirs has a house, or pays car insurance or homeowners insurance, you'll know that year to year this might change. But what we're talking about is it's fixed. Once the rate is set, once that property tax bill comes out, once the insurance for the year comes out, it's fixed for that given year, that contract basically. Depreciation, maintenance, those are generally fixed. Lease payments, and then salaries are generally going to be fixed. So we have committed fixed costs. Those are basically costs that we have some sort of agreement or contract that are forcing us into those. We've committed to them. So a lot of the times leases or salaries or property taxes and insurance, those are all committed fixed costs. Some sort of third party or agreement is binding us to that fixed cost. We also have discretionary fixed costs. And those are basically costs where, yes, they're fixed. They're not going to change just by their activity. However, we as the business could say, you know what, we don't want to have that cost anymore, so we can walk away from all of it. The example I think you'll see in the book is if you have an advertising campaign. You might have to spend $10,000 on an advertising campaign, and you're going to spend that whether the campaign brings in 1 new customer or 50 new customers. However, if you decide tomorrow you want to cancel the advertising campaign, in theory, you could get away from that. So committed is there's generally some sort of third-party agreement where you have some sort of contract where you're locked in, at least for the short term. Discretionary is, yes, it's a fixed cost. There won't be a change in the cost depending on volume, but the business could walk away from it and decide tomorrow that they're going to step away from that cost. And we can see here visually, the line is straight. Doesn't matter the volume of guests. So whether we had 0 guests or 5,000 guests, the fixed cost is going to be the same. And so if we think about that, and we think about business structures and what the breakdown is of fixed versus variable costs for a business, fixed cost structures can be very, very risky for a business. Let me take a step back. They can have a very big risk and reward factor. If we think about a fixed cost, and here, if we have 0 guests, we still have to pay $100,000. However, as we grow 5,000, 6,000, 7,000 if the graph extended, we're still only paying the $100,000. So whereas variable costs, for each additional guest, we have an additional cost. For a fixed cost, basically once we get over that hurdle, everything on top of that would be profits. So a business that has a high fixed cost structure runs the risk of having a bad year and still having those costs, but at the same time they run they hope that once they clear that $100,000 hurdle here, or whatever their fixed cost hurdle is, that they're going to have a much better year. So with a fixed cost structure, you have the risk of having a bad year, but you are hoping and you have the reward of having a good year where your revenues are increasing, but your costs won't. So that's kind of that risk-reward relationship when it comes to fixed costs. Variable costs, on the other hand, kind of the revenues and the bottom line are going to be, or the net income, I should say, not necessarily revenues, but the net income, if you have a fairly high variable cost structure, your net income is going to be relatively flat or relatively consistent, because it won't matter if you sell 0, because if you have 0 revenue, you have 0 expense in a hypothetical perfect world if everything is variable. At the same time, the more you sell, the more cost you have. So that kind of bottom line, that potential to have a really, really big year is kind of down a little bit, just because as your revenues should be growing, your expenses would be growing as well versus a fixed cost structure. So our equation here for our fixed cost, basically our total fixed cost equals our fixed cost. There's no change, there's no impact on the volume. Just keep in mind here, and we mentioned it in the slides for chapter 2, the fixed cost per unit is inversely proportionate to volume. So as that fixed cost, it's fixed in total, as we have more and more guests or more products, we're spreading it out. So actually the individual cost per unit fixed wise is actually going to be decreasing. Whereas if we start losing customers or losing products, using units sold, that fixed cost is spread out over less units, and therefore it's going to rise. But just keep in mind, your fixed cost per unit, it can be a little bit misleading, simply because we're not really every additional cost, every additional unit doesn't cost that amount of money. It's just strictly an allocation. So when we start talking about, oh, we're going to produce one more unit, we don't have to pay that fixed cost per unit. It's just an allocation of that larger total number. So just keep that in mind. And that's where sometimes businesses can lose sight of, if we bring on this additional client or this individual job, we might lose money because they're including that fixed cost per unit into their equation. So we're going to talk about that more as we go along in the semester, but just keep that in mind. It's really the fixed cost per unit is kind of just an accounting allocation. It's not a true, we have to pay another $20. We've already paid that when we paid the monthly rent or the monthly utility cost. We don't pay it again on a per unit basis. Again, here, just like with the variable cost, the fixed cost here, I think we've covered, so I'm just going to skip through this slide here. So now that we've understood our mixed and our fixed, or our fixed and our variable cost, I keep jumping to mixed cost because that's the slide we're on. So now that we understand our variable cost, how they behave on a total and a per unit basis, fixed cost, total and per unit basis, we now are going to basically mash those together, and we're going to say, all right, well, in real life, sometimes we have mixed costs. Mixed cost is basically a cost that has a variable and a fixed component. So here they're talking about the hotel utilities, where they have a fixed portion, so basically the cost of having that common area lit and heated, etc. But then we also have, as we have more guests, we have additional costs, because if we have a guest staying in a room, generally they're going to want to use the water to take showers, they're going to want the heat to stay warm or the air conditioning to stay cool. So if we have no guests, we still at the very minimum have to make sure the common areas are lit up, or if we have one guest, we still have to have that common area lit up. So we have a fixed component, but as we add more and more guests and they're staying in more and more of our rooms, we have to have more additional costs associated with that. So mixed costs, they have that fixed, basically that floor of, even if we have zero, we still have a cost. At the same time, as we're getting more and more customers, more and more activity, that variable component grows and grows and grows. So we can see here, we're basically combining our variable and our fixed graphs together. We have that fixed floor as well as that variable increase per unit or per guest. In this example, we have $8 per guest. So it's going to go up tick by tick by tick at that rate, that slope, $8 per guest. However, if we had zero guests, we would still maintain that floor. So basically moving up from zero as our origin under a true variable to whatever that fixed component here, $8,000 cost component, that would be our origin for this particular mixed cost. So if we think about that, and one of the things I've challenged in the in class, the face-to-face classrooms, is just think about in your own lives, what's an example of a mixed cost that you encounter that you might have to pay for, or maybe just that you can think about. And some of the things they've talked about, is their cell phone plan, their car, the expense of their car. So these, if we talk about your car, you have a fixed component maybe in your insurance or your loan payment if you have a loan, if you borrow money to buy your car. But you also have a variable component, whereas if you drive more, you have to buy more gas, you have to have more oil changes, more maintenance, etc. But at the same time, if you don't drive your car at all, you'd have no gas. Maybe the oil change, I guess, would kind of be more of a fix because it's recommended every certain amount of months or miles, whichever one comes first. But the maintenance might be lower. So for our car expense, yes, if we drive it a lot, it's a lot higher. But if we don't drive it at all, we still have at the very minimum our insurance, our registration fees, our loan potentially. Same thing with your car, your phone bill. A lot of the time there's a fixed component where it's $100 a month for your phone bill. And there might also be a variable portion if you're using it a lot and you go over your data limit. You might have to start charging per gigabyte or megabyte, whatever scam they've concocted lately for those cell phones. So our cost equation here is basically going ahead and combining our variable, Vx, plus our fixed, which is the F, to get our total mixed cost. So we'll see here, and you'll see potentially on the exam, I might talk about your mixed cost, but also what are some of the components. So what does the V stand for? What does the X stand for? What does the F stand for, etc. So again, total mixed cost, it's an increase in volume. It's going to share that characteristic of the variable cost. But it's not going to be in direct proportion because we do have that floor. So it's not going to go double as we double because we have that floor, so it's not starting at 0. So just keep in mind it's increasing, but even if our activity, our x, is 0, we still are going to have that fixed component involved. So that's where we kind of combine the two characteristics of our fixed cost and our variable cost when we're talking about mixed. And this is an important one. We'll see this a lot in problems and stuff where you might have to work around this formula to get through different numbers. So sometimes they might ask for what's the total mixed cost. Other times you might work backwards where here's your total cost, here's your variable cost, what would be your fixed cost. So just be familiar, and when you start thinking about our cost equation, it might be different formulas, and it's just algebraically how do we solve for our different variables. Key characteristics, again, I'm not going to go through these. I think we've covered them. This is in your slide, the same one. Kind of gives you a brief overview of our key characteristics of our mixed cost, and it gives you the formula as well. So we talked about this when we were talking about our fixed cost or our variable cost per unit. Those two items that are basically fixed, those that stay the same, they're constant regardless of our activity levels. It's within a relevant range. So if we think about our fixed cost, and I mentioned this in our example for the roommates, our landlord says we can pay $1,000 as long as we don't go over 5 roommates. So that would be our relevant fixed cost. If he says, all right, you go to 6, legally I can't let you stay in this place, you have to go to a larger apartment, suddenly that fixed cost would increase. So as long as we're in that relevant range where the characteristics hold true, that's our fixed cost. If we have to go up to a larger space, suddenly that fixed cost becomes larger. Same thing with our variable cost per unit. Example was our soda machine. If all of a sudden they say, all right, now the manufacturer is charging me more money, and instead of paying $2, now we have to charge $2.50. So within that relevant range of that, the characteristics of that scenario, it's $2 until that relevant range changes to $2.25 or $2.50, etc. Just keep that in mind. It's fixed. The total fixed cost is fixed, and the variable cost per unit is fixed within that relevant range. We also have this idea of some costs sometimes are characterized as a step cost. So again, it's almost like a mixed cost, so to speak, where as we have more activity, we might have an increase in our cost, but it's not necessarily at a steady rate. So here we have it's fixed over a small range of activity, and then we'll jump up to a new level of fixed. So it's similar to a relevant range, but basically it would be a smaller relevant range where it's fixed for a certain amount of time. And I think this is a good example here diagrammed out. We can see this would be for some sort of daycare, possibly a school, where we have the total cost of the caregivers, which is our y-axis. So we can see here every caregiver is getting paid $20,000. And we can have the volume. So based off of this, every 7 children, or one caregiver can watch 7 children. As soon as we get up to our 8th child, we have to hire another caregiver. Then it's fixed until we get basically past our 14th to our 15th child, we would need a 3rd caregiver. Once we get past 21, again, it would bump up. So it's fixed over a certain small range of activity, so it's similar to our relevant range. So again, it's kind of like, again, a mixed cost, but rather than a steady variable proportional increase, we would have just once we get to a certain characteristic or beyond maybe what the legal limit is or the requirement is from the company, we have to add an additional fixed cost. So you can see if we're thinking about planning out, so if we're in a classroom, maybe where we're at capacity or we're at 12 children, when we start talking about growing and budgeting and forecasting, a business might say, well, going from 12 to 13 children or 13 to 14 children isn't a big deal because we don't have to really bring on any additional cost. It is a small cost for some additional snacks or food. But really, when they're going from the 14th to the 15th child, they might say, there's a backlog maybe until they get up to 14 to maybe they don't add an additional 1 child. They have to wait till there's 2 or 3 children, because suddenly going from 14 to that 15th child is a $20,000 bump in cost. So if the revenue, that 15th child, marginal revenue for that 15th child is only $5,000, that one additional child isn't worth hiring another caregiver. But maybe if they say, once we're at 14, we wait until there's 3 or 4 more children on the wait list, then we allow all those children to come in at the same time, where that additional revenue from the 4 children is going to offset that additional caregiver we need to hire. And then again, after we've had a 5th child and a 6th child and a 7th child, those can just come in. But then once we get to that next kind of small range, that next threshold, we wait until we make sure we have enough revenue to cover that expense. So again, as we see through and we identify all these different kind of cost behaviors, we can see where business decisions would have an impact on if we bring on one more child. Is it worth our time? Is it worth our effort? Yes or no, and we make our business decisions. But if we don't understand that, yes, going from a 14th to a 15th child, great, it's another $5,000 of revenue, but at the same time, it's an additional $20,000 of expense. That might change our decision and change the structure of how we run our business. And last thing, as far as talking about some other cost behaviors here, is just this idea of the curvilinear costs. So in this semester in the book, you'll see in most of the times we try to fit a nice straight line, whether it's a fixed or a variable cost. In real life, generally, even if it's a true variable or a true fixed, there might be little fluctuations. So we try to look at kind of the big picture and smooth it out, just so it's easier for us to kind of talk about the concepts and apply formulas to it. In reality, on the left-hand side here, the volume X, we can see that there's a little bit of a wave, a little crest to the costs, because generally, even if it's a variable cost, it might not go up exactly by that $9 per unit. It might have, we had a volume discount, all of a sudden the supply and demand changed. So they might have different ebbs and flows of costs. So in real life, generally costs don't behave in a perfect straight line at the variable cost or the fixed cost. So they're generally curved a little bit, especially if you talk about your economics professors or your economics class. They generally like to be a little bit more realistic. For the purposes of this class, we like to keep our costs kind of nice and straight, but just keep in the back of your mind when you get into the real world that generally costs aren't going to behave perfectly theoretically straight and theoretically volumed. Variable costs don't go up in a perfect straight line, and fixed costs aren't saying a perfect smooth. There might be additional, fees and costs, etc., associated with it. But it's kind of the theory behind a variable or a fixed cost is what we're talking about here. But just keep in mind, if you ever were to kind of plot out something that we say is a true variable cost, might not exactly be the perfectly nice straight line here. You might have some different ebbs and flows, kind of thinking about like a wave in the ocean, some big waves, little waves, and crests in between. So next we're going to go through and look at how we're going to use account analysis and scatter plots to analyze cost behaviors. So when we're analyzing cost behaviors, and it's something that managerial accountants, business decision makers have to do to really understand and make decisions about their business going forward, we're going to use one of 4 different methods basically. So we can use the account analysis, scatter plots, high-low method, which is the 3 ones that we're going to basically focus on for this class. The last one there, the regression analysis, you can do it in Microsoft Excel. There's software you can do it, complicated models and looking at pretty much all your data points and getting the most accurate picture. For the purposes of this class, though, we're going to use the high-low method, which is basically same idea. We're trying to draw a nice line to predict costs, but it's going to be a little bit of a simpler and something we can do out by hand or can do in our heads versus a regression model, which is what we have to do if you ever get into a statistical class or kind of a higher end operations classes, etc. And then scatter plots and account analysis we'll look at as well. So for account analysis, basically what happens there is we go through and we analyze accounts based on our judgments of how we think the cost should behave, understanding our business. So we basically go through and say, yep, this is a direct material, therefore it's variable. This is a manufacturing overhead, therefore it's fixed, or maybe a mixed element is there. But as we go through and we start to apply things to our contribution format income statement, which we'll see in Chapter 7, which is the next chapter, we really try to get things into a fixed or a variable breakdown. So that way we can put it either above or below our contribution margin line. Again, don't worry about that. I'm throwing a new term in there. But when we start talking about the contribution margin, which we'll see next chapter in the cost, volume, profit relationships, we'll see why we want to break down between variable and fixed and kind of avoid things being classified as mixed, even though in reality most costs are probably more mixed than they are fixed or variable. Scatter plots, and you do this for one of your homework problems, but scatter plots is basically graphing out historical cost data on the XY axis. So we can visualize the relationship and try to see if there's a linear pattern, i.e. there's a strong correlation, meaning we can probably come up with a formula to predict that cost, or if it's kind of just a random pattern with little to no correlation, so the predicting of that behavior gets a lot harder. And for that one, I like to think of that random pattern as, stock market prices. Yes, generally we can see and we can plot out the historical stock market prices, but if we tried to go ahead and predict a stock market price for next week or next month, it's basically throw a dart at the wall, and that's probably going to be as good as a guess if you use any sort of calculation or formula. Random patterns, little to no correlation. All of a sudden it can be going up and then suddenly drop and then go back up. Be really hard to predict. So there's really no correlation. We couldn't come up with a formula to kind of try to calculate that into a straight line. And really anytime we're talking about costs that relate on some sort of traded marketplace, has some sort of market value, that's where we're going to get a lot more of that random pattern. So a lot of businesses, manufacturers in particular, when they're talking about the raw materials, metals, components that are traded on some sort of marketplace, and I used to work on a company, a couple of different scrap yards, and their business model was predicted solely on the price of fluctuations of different metals that they're buying from the general public. So they can be doing the exact same thing month in, month out, year in, year out, and they can suddenly have a great year if the market prices are suddenly going higher, and then really under no control of their own, they can suddenly have a very bad year if the market goes in a different way and the prices for some of those metals they're buying goes down. So it's identifying maybe some of the early warning signs that things are going up or things are going down, and trying to use some good understanding and knowledge when there's some random pattern, and just trying to be able to be prepared and be able to move quickly to kind of keep ahead of those markets. Whereas with a linear pattern, you can predict and make better business decisions and kind of think about what am I going to do tomorrow based off of what my activity level is, what my kind of cost predictors are, what my equation is, because there's a strong correlation. I know if I'm selling more, I'm going to have to be buying more, and if I'm buying more, I know that the price is going to be X or Y because it's a steady price. Again, when we go and look at these, if there's any outliers, we really try to identify, is it truly an outlier where it's just a one-off or a couple things that happened? Maybe we can identify that here's exactly why this outlier occurred, and we can kind of ignore that and try to get back to that linear pattern. But again, as we get more and more outliers, they really stop being outliers, and it's kind of going to lend more to that. It's just a random pattern. So we can see here our relationship between utility costs and the number of guests for, again, we're talking about our hotel again. And you can see here that just visually that, yes, there's probably a very strong relationship between our utility costs and how many guests there are. You can probably, if you wanted to, with your finger, kind of just go over your screen here, and you could see that, yeah, there's a pretty strong correlation there. We can probably draw a straight line there and try to identify. I'm going to see if I can, with a pen there, I can probably, and apologize if it's not a straight line, but we can probably draw a straight line there. That's what I'm going to go with, a straight line looks like. But you can probably draw a straight line and estimate that, yes, as we go up and up and up, the number of guests, the utility costs are going to go up and up and up. And therefore you could predict out, if we had, keep this line going, if we had 30,000 guests, draw there, go over here, that, yeah, our cost is going to be somewhere over here. So that's where, if you have a strong relationship, we can apply a formula for, or draw out visually on a graph here with a scatter plot. You can use this to predict, all right, if we have less volume, more volume, what's our cost going to be? And why is that so important? Again, so if you have these additional costs, if you want to grow, increase your volume, how much costs am I going to incur? Therefore, how much revenue do I need to bring in? How much cash do I need to have on hand to pay for those additional costs? So next, we're going to use our third method that we talked about right at the beginning, the high-low method, to analyze our cost behavior. And again, here with our high-low method, we're going to talk about, again, sometimes we'll have information on a scatter plot. Other times we'll just have a data set, kind of a table with our X and Y axis. So here, we're going to have kind of a three-step process when we're talking about the high-low method. And I'm just going to talk about it with this kind of slide and go to the next slide. The book has their own way of talking about it, and they talk about the rise and the run of the line. I like to just kind of use more accounting type terms. when we're talking about the high-low method. So step one, and you might want to write this down because it's not going to be on your PowerPoint, just kind of the way I like to think about it. Step one, what you want to do is you want to find your high and your low for activity. That could be, in this case, it could be the volume number of guests, it might be the number of units sold, it might be the miles driven. A lot of times for these examples, it's a car expense just because your volume is your mileage and it has a mixed element to it. You want to find your activity, your high and your low activity, and then you want to find your high and your low dollars. Now just keep in mind that on these problems, sometimes the highest activity isn't necessarily your highest dollar. What you want to do is, because you're taking a data set, you're taking an X and a Y, so when you find, always go and start with what's your highest activity, and then find that highest activity point, and you want to take as your highest dollar that corresponding dollar. So if you have a month, a lot of the times they have months where your highest activity month was not necessarily your highest dollar month. Always go with what was your highest activity and take that corresponding dollar. Don't go with what was my highest activity month, say March, and then what was my highest dollar month, maybe that was June. Once you find your highest activity month or highest activity data point, just take that corresponding dollar. Okay, so highest activity and then the related dollar. Same thing, you then find your lowest activity and then you find that lowest dollar. Same method. Once you find the lowest activity month or lowest activity data point, you take the corresponding dollar that goes with that month. Don't go searching again for the lowest dollar. Excuse me. So that's step one. Step two, you're going to go your change in dollars over your change in activity. So your high dollar versus your low dollar over, so that's your numerator. So high dollar over low dollar divided by your high activity minus your low activity. So your change in dollars over your change in activity. So in this case, we'd have our change in dollars, which you can't really see based off the scatter plot. Generally, it'd be a lot clearer if they just gave you this information so you know exactly what each one of these data points are. Usually, and when you see in the homework, it's going to be a table that, just tells you, here's January, here's the activity, here's the dollars, here's February, so on and so forth. So here we can kind of guesstimate our activity for dollars for July. Looks a little over 200,000, so at 210, something like that. And then for our lowest activity, January, maybe 120. So you'd have a difference of about $90,000. That'd be our numerator. Our denominator, high 25,200 minus low 13,250 would be your change in activity. That'd be your denominator. So what that tells you, when you calculate your change in dollars divided by your change in activity, that tells you your variable rate. So that's basically, when we think about division, that's basically our dollar divided by, in this case, number of guests, so dollar per guest. And that gives you your variable rate, your V, if you were to say. So that's step two. Step three is you take your formula for your total mixed cost, your Y equals V times X plus F, and now you plug in, using your high data point, you plug into that formula. So in this case, it'd be our, say, 210,000 equals our rate that we would have just calculated. I'm going to throw out $10, and I'm going to go through the next slides. Will have the book's way of doing things. That'll show you exactly what we're talking about here. But you do your calculated variable rate that you calculated in step two, times your high level of activity. So again, this is 25,200, and then plus your F. So then you solve for your F. And then you can basically rewrite your formula to Y equals your variable rate calculated in 2 times whatever now activity rate you want plus your F that you've calculated in 3. And the reason why we use the high-low method, and the reason why we try to calculate and come up with this formula, is again so we can predict our costs. With our scatter plot, we would just kind of keep drawing the line and estimate it. For this, we can really plug in any sort of number and really come up with our prediction of what that mixed cost will be based off of our formula. So we can see here again, there's step one, find the slope. So again, slope equals our variable cost per unit of activity equals rise over run, or change in cost over change in volume. That's our step one. Again, step two, and we can see here we had our units, 13,250 was our low, high was 25,200. our cost low was 114. July, our high was 209,600. So we can see our change in dollar, and this would actually be, they're kind of combining my step one and step two into their step one. I like to say, let's find our activity and our dollars, high, low, and then plug it into our change in dollars over change in activity. So we have $8 per guest. Step two, we plug it back in to our formula y equals Vx plus F, and we insert it. They say high or low. I always say just throw it in the high. Always just use the high. Just that way you don't have to think about, is it high, is it low, do I use a random number if there's other ones. Just always take the high. If you do the low, it's going to come out the same because it's the same data points. If you just always go with the high, it just makes your life a little bit easier. So we plug it in. Our high total cost was 209,600 equals our 8 that we just calculated in our step two. In this case, the book saying it's their step one, and then it's times our 25,200, which is our activity for our high point. When we calculate that, we come up with our F equals $8,000. So again, last step there, we can now write our equation. Our mixed cost y equals our $8, which we calculated, times whatever activity we want to use, plus 8,000. So we can see there that now we can predict for this hotel, and if you were the manager of the hotel or the company's accountant for the hotel, we could kind of come up when we're maybe doing our forecasting. You might have historical data based on the number of guests by month. You could go ahead and try to calculate what your anticipated utility cost was on a month based on the number of projected guests. And that way, when you start to go through and you start doing budgeting and forecasting, we can have a good idea. So in theory, businesses could have a bunch of these formulas built right into their budgeting process, and they'd be able to calculate estimated mixed cost for their business. And that way they can understand, all right, maybe August is a busy month for this hotel. What's the amount of cost that we're going to have to incur for utilities based off of that number of guests? So we can project out how much money we need to have, how much money we're going to make to share that with our decision makers. So our conclusion on the high-low method, and again, if you want to write these down, step one, you find your highest and lowest activity and dollars. And again, if it matches up where your high dollar and high activity isn't the same month or isn't the same data point, always go with what's your high activity and take that that the dollar relates to that month or that data point. Same thing with low. Find your low activity and then the corresponding low dollar. If they're not the same, don't try to pull and mix and match. You want to basically, if we're thinking about our scatter plot, we want to take one dot on there. We don't want to mix and match dots. That's step one. Step two, change in dollar over change in activities. That gives you your variable rate. Step three, plug it into your y equals Vx plus F using your high data point. So our advantages there, it's simple. So it's only using two data sets. It follows the familiar y equals mx plus b. That's the mathematical way of doing it, the formula. For us, it's going to be our y equals v, variable rate, times x, which is our number of output or our amount of activity, plus instead of b, for our purposes, we're going to say f, which is our fixed cost. Disadvantages, only uses two data points. So it's not going to be a perfect representation. We're going to get a much more accurate if we use that fourth method, the regression model. However, we're going to use two data points here. It's going to give us a rough estimate, a quick estimate of what those costs are going to be. And it gives us a good idea of the predictors. And we're going to see that when you guys do some homework and some exams and quizzes online, that you'll be able to do this and calculate quickly what some of the mixed costs at different levels of activity is. It'd be very difficult and be more of really like a stat class or an operations class if you want to use that regression model. So that's the end. That's it. Chapter 6 is over. So that was chapters 2 and chapter 6. Again, we're talking about cost behaviors and trying to predict cost. And again, why that's so important is that businesses want to understand at different levels of activity, different outputs, different inputs, what the offsetting costs are going to be or savings will be. And that way they can really project and make decisions and forecast and make sure that their plans, have a fighting chance to make through, make sure they have the cash. Because if you think about it in businesses, cash is king. So if we want to spend more, we want to make sure we have that amount of money in the bank to be able to spend that. So that's the end of chapter 6. So you can go ahead. There's some activities posted on my courses. You have a homework assignment on the publisher website, the Pearson site. You also have a quiz due at the end of the week on the Pearson site. Don't forget where those your homework. It's based on really your effort. I can go in and see how much time you spent on an individual problem or overall. If it looks like you put some effort in, you only got a 50, but you spent a good amount of time, you put in some answers, you exhausted all your efforts. I can see how that data, the website is pretty good with giving us a lot of statistics on the instructor side. So I can go in and kind of understand, yeah, you only got a 50, but you spent some time on it, and I can see your quiz grades are better and improving. That's where you're going to get your effort on the homework. So your homework's not designed for you to be perfect and get 100. It's there to kind of try. You can get your feedback before you try to get your quiz, and that's where your grades count. So yes, you got a couple of assignments on the My Courses. Keep an eye on those. A couple of assignments on the Pearson site. And then we'll talk to you next week for Chapter 7. So as always, if you have questions, shoot me an email using my UMass email. Don't do it through the Pearson site or doing it through My Courses. Just send me a regular email, u_cjacobson@umassd.edu. And we'll talk to you soon. Thanks, and have a good week.